Hello there, folks. Welcome into today's video. Oh my gosh, it's a 6-piece, folks. 6 videos for me to react to, okay? 4 longer ones and then 2 super short ones, okay? First one up, we are going into a recession and there will not be a soft landing, Mr. Shorthill's Capital says. So let's hear what he has to say in regards to that one. That one's from literally 27 minutes ago. This one, interest rates stay higher because the economy is good and stocks are following suit. So I want to hear that one. That should be interesting. The S&P may be near a floor that investors can get optimistic about. Okay, now we're talking. A recession isn't imminent, says Cameron Dawson. We're going to listen to what Cam has to say. Always love to hear from Cam. And then these two, I got to react to these first because the market's still open. I got to figure out if I need to sell out or whatever. Okay, Meta's literally my biggest position in the public account. Kramer's talking about it. I don't know what he's about to say. And then Tesla's my second biggest stock in the public account, so I'm a little scared. So we got to watch these ones first, and then we'll work backwards, and then we'll start here. Okay, so appreciate everybody joining me as always. Thanks so much for being here, folks. We got a 6-piece to get into. Appreciate y'all. If you want to support my channel, you enjoy the content I put out, join me on Patreon. That's pinned comment down there. You also get to see the moves I literally just made in the portfolio here today. I bought 4 stocks here today, literally. So appreciate you guys being here as always.
Final trading session of the week is 2 minutes away. Meta.
Yeah, David, I know that you're an aficionado of catalyst watches by research companies.
Yes, of course. Catalyst watches, sure. Yes. I'm always on alert for catalysts.
Right. Well, Citi's putting out a catalyst about Meta's got a big festival coming up, 27. Okay. And they're saying you're going to see, this is the 90-day positive catalyst watch, ahead of Meta Connect on 9/27. We're expecting more details around Meta's Gen AI, generative AI, that, plans and results in late October. And David, it may be a huge increase in Reels. So I think this is very, very important. I understand that Mark is making incredible progress in this.
No doubt. But here's the thing, okay? This is what frustrates me about Wall Street. I think everybody knows that should be the situation. Come on, man. Reels has been taken off. This isn't something that's new.
Improving online advertising situation could take Meta up big. So Catalyst watch Meta. What else do you need?
Okay, it's 12 months. It's already up 107%. Year to date, up almost 150%.
Well, all I can tell you is that I expect some big things from this conference, and I think that Meta's got it's Meta, it's Amazon, and it's Google. That's the big, like ABC, NBC, CBS when we were growing up. That was it.
It's the big three. What of AI? Generative Microsoft is that? Oh, advertising. Yeah.
Okay, so this man right here actually brings up a pretty poor point, okay? And I need to tell everybody this, okay? The poor point he brings up right there is, it's up so much. It's irrelevant, man. It's irrelevant. However much it's up or down year to date or in the 1 year is completely irrelevant. It all goes back to valuation. Look at Meta's forward P and tell me that stock's expensive. You can't do it. It's literally impossible. The fact is Meta is still a buy today. Is it as huge of a buy as it was at the beginning of this year or that it was back in November of 2022, October 2022? No, it's not as much money to be made, but there's still money to be made if you're buying Meta today. Bottom line in regards to that, when you look at that forward P, when you look at the balance sheet and the income statement and where net income is going to go over this next few quarters and obviously next few years, it's still a buy, okay? Let's hear what Kramer has to say in regards to good old Tesla, my Tesla.
Carl, our colleague David Lefebvre would say, what's the key to this market? And today, if we're going to have a turn, there's a negative piece by Barclays about Tesla, talking about a slowdown drive to potential missing quarters. If Tesla is able to turn, then I believe we could have a substantial rally because this is a very negative piece.
Do you buy the Times piece that this UAW regional director says workers at Tesla are starting to think about organizing, or is that just self-serving union commentary?
I was talking to Dave about organizing. Anyone talk about organizing? There are no, Tesla doesn't, what are the machines organizing? They talking to each other? Like the ones in NVIDIA?
They do have employees. They'll hire a lot more for the Cybertruck as that gets rolling.
Listen, Dave, that's a right to work state.
Yeah, it seems unlikely. Unlikely that there would be.
Yeah, I agree with you. But I just want, this is a true negative piece about numbers. And if Tesla can rally on that, then that says, you know what? We're done dumping on every single stock in this market except for the refiners.
So,
one group. There's a good leadership group.
Valero, yeah.
Oh, yeah. Bolero and Valero. And Valero's not doing that well, just so you know.
Okay.
how are you going to close out the week tonight?
Okay, so I'm having Federal Realty on because I want to find out about the state of Reach, which was just...
Hey, you guys want to know a stock that is getting absolutely pummeled here recently? One of the members of Private Stock Group brought this one up to me. I was like, dang, man, that stock has fallen that much here recently. And it's actually a stock some of you guys might enjoy their product very much. And man, has it gotten just absolutely obliterated. And it's actually Callaway Golf. And if you don't know, Callaway owns Topgolf. And so I'm sure a lot of you guys love Topgolf and go to Topgolf. But yeah, that stock's been getting obliterated. So I guess the view is that, if a recession hits, no one's going to buy golf clubs. No one's going to go to Topgolf, or it's just a lot less people. And that's going to be bad for Callaway. And obviously, they've added quite a bit of debt over the years with higher interest rates. Not an ideal situation. So that's the view. But yeah, man, that stock has gone absolutely obliterated here recently. Okay. Alrighty, guys, let's start getting into these big dogs here. We're going into recession, and there will not be a soft landing, says Short Hill Capitals. Say it with your chest. This is what I love. I love when the market goes down, because then you see the big time bears start to get big time bearish, man, and they start saying stuff like this: we're going into recession. Like they wouldn't have said this a week or two ago because the market was too good. The market starts getting a little weak. All of a sudden, they say it with their chest.
Where do you go from here? And I think it's important to note the Nasdaq and the S&P also on a 3-week losing streak as well.
I think you actually have to go a little bit further, because July 31st was really the peak in the S&P. And then all of a sudden the 2-year and the 10-year start moving up. And I think as soon as the 2-year got to 5 and the 10 years hit that 425, all of a sudden equities can't handle that. And so you're seeing really that digestion of higher for longer, which Jay Powell just reiterated. And so I think that ultimately this is going to be settled, because typically stocks follow bonds, but right now bonds have been following stocks, and that all year long stocks have said no recession, soft landing, rates are going to cut next year, while bonds have been saying inversion, which means recession, recession, recession. And now bonds are saying, hey, you know what? I think the stock market was right. And so you're getting that uninversion of the bond market. And to me, that's the whole story here, because you really have to re-rate what can multiples be, how high can the stock market go if we're going to continue to have multiples rates be higher for longer.
There's like this view of like, who's right? Is it the bond market? Is it the stock market? It's been a big debate from a little more of the sophisticated investor crowd, I guess you can say, this whole year. Who's right? The bond market or the stock market? The stock market's basically telling you no recession. The bond market is basically telling you, oh yeah, it's coming, okay? And here's my view on that. There's also a view that bond investors are smarter than stock investors, okay? Not my belief. Here's the deal. Do bond investors look very smart? Like, I don't know, I'm sure a lot of you guys don't keep up with the bond market. It's been getting obliterated. One of the worst times to be a bond investor in history, literally. Like, it's been awful. And there was an interesting piece I read from Bill Ackman here recently, who said he was, speaking to a very influential person in the bond market. And that guy was basically just saying, man, there's just so many bonds. There's just so many bonds. It's been brutal. It reminds me very similar to if you were in the real estate industry, kind of probably back in like 2009, 2010, 2011, where it's just like there's so much inventory and not enough buyers. That's what it seems like in the bond market right now. It's been brutal for these folks, beyond brutal, to be honest, and I'm not so sure they are the most sophisticated investor in the room.
Question for you. I mean, what's next? We're about to enter Q4 next week. We've had a pretty strong start to the year, but a lot of disruption recently, also some big macro things and some U.S.-specific things like a possible government shutdown, other issues here in the U.S.
Yeah, so what's next is earnings season. And as opposed to the last year or so, expectations are higher. They're more optimistic.
Yeah, earnings season is still quite a ways away, folks. We're still about 3 weeks out from bank earnings, 3 to 4 weeks out from bank earnings. And if you're thinking about big dog companies, the big techs and all those guys are still about 5 to 6 weeks away from all those guys reporting.
So now you've got to actually bridge that optimism with reality. I personally think there's a chance it falls short. Look, I think the market, I've been cautious in the market for a number of weeks, remain very cautious on it. I've trimmed exposure. Here's the issue. I do believe we go into recession. I don't believe there'll be a soft landing. I'm still amazed by some of the lunacy out there that as recently as a month or two ago, some strategists, some whatever, money managers saying the Fed's going to start cutting rates. They're not going to cut rates. They're going to leave rates the way they are. So we've seen a delayed reaction to the massive tightening cycle that we've had. I don't think it gets any better. I think it gets worse. And there are a number of factors. Additionally, inflation is not really under control. Okay, we've had the easy move down from 9% to 3.5%, 4%, pick a number. But guess what? We're poised for it to go higher. Why? Because of energy, because of the UPS strike, because of the UAW strike, because of the Inflation Reduction Act. We haven't even started to deploy capital. Wait till we start doing it. So you've got all the triggers for inflation going higher. So you cannot tolerate rates like that. We're a consumer-driven economy. 2/3 of the economy is driven by consumers. Now you see these cars rolling off leases. So I've had two. Fortunately, I can afford it. But the cost of leasing a car, the cost of buying a car has gone up 20 to 40%. So where do consumers make choices? In addition, you've still seen, while rents may be coming down a little bit in some areas, basically they're still on the rise. So where do you take it from? You got to pay more for energy. Okay, it's not like you've seen grocery prices come down measurably.
Good point.
So it all adds to pressure on the consumer that drives the economy. And guess who's going to pay for the UAW wage increases? You, Bryn, me, Rob. Maybe not Rob because he's America's guest, so who knows? But in general, it comes to the consumer. That further takes wallet share.
So Weiss, to your point, as if we didn't get the message from Jay Powell, Boston Fed President Susan Collins saying today she feels...
I'll let this clip finish out, and then we'll talk about Mr. Shorthill's capital.
We need to keep rates higher for longer. She is a voting member this cycle. So I think you're right. The Fed is just trying to make it clear to the market. Whatever you thought was going to happen, we're trying to make it clear.
Right. So final word. Past is not prologue. Okay. Just because the equity market has held these levels for the top line, lots of stocks have suffered, right, doesn't mean that's going to continue to be the case. I believe it's a delayed reaction and the markets go lower. They definitely don't go higher and hit new highs.
Okay, so this is why I love this market kind of going lower right now and being in a weaker spot, because these folks that want to be super short, want to be super bearish, finally can be it, okay? I watched Fast Money last night, and a lot of those guys on there are always lean negative, lean bearish, and they haven't really been able to be bearish for a bit, and the reason being is because the market was so strong, so they don't want to look like the big bears out there when the market just keeps going up and up and up and stocks are going up, okay? And so this Short Hill's Capital, man, I remember reacting to him, late last year into early this year, and he was so bearish, and so, it's the end of the world, all this stuff, okay? And then all of a sudden he flips around, when was that, late spring or early this summer, and all of a sudden he flips, and I was like, what? Mr. Short Hill's Capital is flipping, right? And now all of a sudden you get a little weakness, and then like the bear in him just comes out, and just, that's why I said, say it with your chest, because, yeah, man, I like it. I like it a lot. It makes me feel more comfortable. I like it when the bears are in aggressive mode and everything's going to be the end of the world. It makes me actually feel much more comfortable in the market than when they have to be timid and like the bulls feel like they can just be out there. All right, next one up here. Interest rates stay higher because the economy is good and stocks are following suit.
The market's chief investment strategist, Brian Belsky, has a year-end target of 45.50. Brian, it's good to see you. So how does the economy sort of evade what some would argue are increasing effects from rates?
Well, great question, and good morning, everyone. Thanks for having us, Carl. I think it's less about the economy right now and more about the stock market trying to digest what is increasingly becoming normal. If I go back and look at what we wrote in our year ahead piece that we published in November, the predominant theme was this return to normalization. And I think that's what the broader trend is, quite frankly, over the next 3 to 5 years. You have to remember that the average 10-year Treasury over the last 70 years is 5%. And what we think is happening right now is that the stock market, in terms of the U.S. stock market, is entering into this kind of normalized performance pattern of high single digits, low double digits, where earnings will be high single digits. And we'll see some sort of a trading range of the 10-year Treasury somewhere between 3 and 4% or 4 and 5%. in GDP of 2 to 3%. How we get there is we've had shock last year and awe this year, especially considering what's happened with stock market performance the first half of the year. And I think the biggest troubling factor is this whole, I'm getting bored, by the way, with this whole higher for longer interest rate thing. Of course we're higher for longer. Zero was not normal, Carl. Yeah. Zero rates were not normal. And I think what we're going to do is settle into normalized trading. And so I think the investors that have been in the business less than 10 years, they're not going to understand this, quite frankly, because we've reared an entire generation of investors that only believe that you buy stocks because interest rates go down. Interest rates stay higher because the economy is in good standing and the stock market is following suit.
Yeah, it's funny. B of A's.
You know, that's an interesting point that I was making, oh gosh, probably 18 plus months ago, right? You know, I'd bring out kind of the point that, you know, the stock market has plenty of time periods in the past where it does very well with, you know, Fed funds rate 4, 5, 6, 7%. And the stock market just chugs along very, very good. And companies are just fine, and the economy is just fine. So yeah, it's a very similar point to what I brought out in the past. Like, people assume just because the Fed raises interest rates, like the economy has to crash. It doesn't really work like that. It can crash, and the Fed lags do eventually catch up and cause problems. But it's not always right when you think it's going to be. It's not like right when the Fed starts raising rates or something like that. It can sometimes be several years after they started raising rates that all of a sudden it starts to hit, and maybe it hits the economy, and then the Fed's like, crap, we got to start bringing down rates because we're too high. We need to be a little more stimulative in the market. We need to be a little more on quantitative ease inside than quantitative tighten inside. But it's a process to go through.
Good desk note today where they talk about the movie Wall Street, 1987, where the real estate agents are going crazy with business with mortgage rates at 8, 9, or 10. That said, Brian, I do wonder if you think the shutdown, if we get it, the strike, if it expands, and student loans can offset any kind of good seasonality going into year end.
Well, good seasonality is kind of what everyone's kind of keying in on. You know, we had a bunch of meetings with institutional clients this week, and there are some fears with respect to the government shutdown. We kind of quelled those a little bit, especially going back to 2011 and saw what happened. You know, the president's approval ratings at that time are much higher than the current president. I think we're going to get a better standing in terms of trying to get this shutdown done faster. That's number one. And the student loan payments, I think that is a bit of a hangover. But remember, you just said in the prior hit that cash levels are up. The consumer's been very smart.
I like Bath and Body Works going down. That could be a stock I end up buying at some point.
Of their money. So I think in terms of interest coverage ratios on the consumption side, I think we'll be able to weather that. I think the bigger issue is what happens into next year with the added volatility of an election and stock market gains this year that people weren't really positioned for. So I think we could get a quote-unquote chasing factor in the fourth quarter that will cause a lot of institutional accounts and institutional money managers to kind of chase the market.
So then, Brian, how should investors be repositioning now, given all of those confluence of factors? In your latest note, you talk about technology, energy, and industrials historically benefiting during periods of high interest rates. Is it too late for those sectors?
No, it isn't, Leslie, and I don't think it's too late for your favorite sector, financials, that you cover. Everybody hates financials, but I think you think of financials and banks in particular in a very bifurcated fashion, meaning the really big ones are going to do well and the really small banks are going to do well. Everything in between, I think, is going to have a harder time. And then also the scale theme, the theme of scale, asset managers and brokerages can do really well. I think the big banks are going to come out with new products that are going to help cover some of these new debt costs, number one, especially on the consumer, but also on the commercial bank side. So look for that. Number two, value is starting to come back a little bit. And oh, by the way, dividend growth and lower kind of duration assets are starting to work. On your cyclical call, I think that's...
the big banks are going to innovate? That's got to be the most aggressive call I've probably reacted to all week. What? The banks innovate, come out with new products and services?
Be a call for 2024. I think even more cyclical on the industrials, parts of energy and parts of materials I think can do really well as we start to see increased onshoring and capacity coming back in the United States, really defined by AI and robotics.
So a funny story, I believe back in the day, that guy was bullish on Cabela's, which was a stock I was invested in back in the day, and if I recall, he was one of the only people that would ever go on CNBC and talk about it. I think that's the same guy. So Now, in regards to big banks, okay, am I bullish on these guys, all the banks? The answer is no. I actually lean more on the side of the big short guy in relation to big banks, right? Because the big banks aren't paying out the big savings account rates, so money's flooding out of those big banks. The capital requirements have gone up substantially, right? And then also, I think if there's a recession, loan losses are going to go up. Losses in general are going to go up. That's going to be a problem if we do actually, the Fed lags actually catch up to us in 24, and we do have that situation. So I just don't like the whole situation with the banks from so many different sides, to be quite frank. I don't like it in a situation where interest rates are high. I think it's going to hurt them because I think money will continue to flood out of those guys, and they'll move money over to places that they can get 5% on a savings account or 4% on a savings account and CD accounts. And that's not JP Morgan Chase. That's not Bank of America. That's not Wells Fargo. So people will move money. And then if interest rates do come down, it's likely going to be because we're going in a recession, which means likely losses for the banks will go up quite substantially in that sort of situation. So, yeah, I don't think they're the worst stocks in the world. It's just they're probably not the best right now. Alrighty, next one up here. The S&P may be near a floor that investors can get optimistic about. Interesting.
With a lot of rate pressure, also looking at the dollar right now, moving about 2% higher over the last month, and some technical indicators showing the Golden Cross that we could see an even higher move higher for the dollar.
Well, Frank, I think obviously you have to have additional concerns be added to the equation in order for share prices to decline. As of last night, S&P has actually moved into a pullback, which is a decline of 5 to 10%. And I target the 4,200 level on the S&P as a potential bouncing point, mainly because it represents a Fibonacci retracement level, but also was the high back in March of this year. So it represents a floor at this point that might be able to be optimistic for investors.
Okay. All with that in mind, Sam, what is your WEX word of the day?
The WEX word of the day is countdown. That's because I think investors are counting down the end of this seasonal weakness period, which starts in August and ends in the first week of October. October has 35% more volatility than the average for the other 11 months of the year. Investors are counting down the beginning of the Q3 earnings reporting period, which right now is expected to show a decline of less than 1%, but 54 of the last 56 quarters have had actual results exceed end of quarter estimates. Also, countdown to the Fed funds rate tightening cycle. Major central banks around the globe have ended, or at least signaled that they're ending their rate tightening program, and investors are counting down when the Fed will do the same as well. And then finally, traditionally, markets bounce once the Fed has paused and investors anticipate the next move, which would be a cut in rates.
When you said countdown, I thought you were actually looking at the potential government shutdown. Concerned about that? We actually had a guest on earlier this week that the shutdowns don't actually hurt the markets. They actually get a bounce from it, but worried.
And by the way, in the time period that Fed pauses, okay, usually you kind of have like a little Goldilocks type time where the Fed's not going up, they're not going down rates, they're just staying at whatever they're at. And we could already be in that pause time frame, by the way. We just don't know it yet, right? And there's just a lot of debate are they going to move one more time in November, or are we already at pause state? So just assume we're at pause state. Many times the market can just kind of have this like Goldilocks type time where the market just does pretty well and the economy holds in, right? And then eventually you start to get some real weakness out there. And then those Fed lags of all that room that they basically raise rates, it starts to catch up to you. So we could be in that time period right now. We just don't know it. We'll certainly be able to look back at, in the future at some point in time and know exactly where we're at. But we could already be there, just so everybody's aware.
This might be a different environment when we see things like the U.S. credit rating downgraded and other big macro things impacting the U.S. right now.
Well, I agree with the person you're quoting in that we have had 20 government shutdowns since 1976. In the week before the shutdown, the average change was a minus 0.4% for the S&P. On the day of the shutdown, it was a gain of 0.1%. Basically, it's more of a concern for tourists than it is for traders.
All right. I also want to get to your pick of the day. It actually plays off the rising rates we're seeing. It's an ETF, ticker GCOW. Explain why that's a great play today.
Well, the Pacer global cash cows, what they do is look globally at companies with very low free cash flow yields, and also then looks to those with a high dividend yield. And right now we're looking at a ETF that has beaten its benchmark over the 1, 3, 5 year period that also yields more than the 10-year note.
That's interesting. Never heard of that one. I like that guy, though. I like that guy. He knew his stuff, man. He had all his numbers off top of his head. I appreciate him. So that was interesting, that last one he shared with us there. Alrighty, last video up to here. Cam. Always looking forward to hearing from Cam. What's Cam got to say? A recession isn't imminent. Alrighty, Cam. Let's hear it.
In San Francisco, this make-or-break hour begins with the outlook for stocks. 24 hours after the Fed signaled interest rates could be much higher for far longer than the markets thought. That surprise sending interest rates higher, stocks lower, and that dynamic, as you probably know by now, continues today. There's your scorecard with 60 minutes to go in regulation. Stocks in the red throughout. Not significant losses, but nonetheless weaker across the board. The Dow dragged by Cisco today after that company announced it would buy Splunk for almost $28 billion. And speaking of tech, NASDAQ, the weakest of the three majors following the Fed decision and Chair Powell's comments. NVIDIA and Amazon among the weaker names today. I did mention yields to you. They are the real story of this day. They hit fresh cycle highs across the curve, and that's probably taking a toll on tech as well today. It does take us to our talk of the tape, whether the Fed just upended hopes that the rally in stocks might soon resume. Well, let's ask Cameron Dawson, Chief Investment Officer for New Edge Wealth, back with us today. It's good to see you. Is that what happened yesterday? Did the Fed do that?
I think that the reality that higher yields is definitely setting into this market has been one of the things that has surprised us the most this year, this ability for the market to shrug off a tighter Fed and higher yields. But I think now we're at the point where the market looks around and says, hey, maybe we won't get those cuts in 2024 as early as we expected. And if we look back when we traded to the high back in July, you were trading at 20 times forward for the S&P, 33 times on the NASDAQ. And so that was a very full and rich multiple if you weren't going to get support from the Fed. So that was the message that the Fed gave yesterday, which is why we think that these interest rates have really now started to weigh.
Was this more hawkish than you expected?
No, we expected this outcome in the sense that we did think that you would see those 2024 rates start to move higher in the dot plot. That's certainly what we saw. It drifted higher by 50 basis points, which really just said that the Fed is saying that just because inflation is moderating, if we're seeing higher growth, that means that they cannot cut rates simply because the risk is that inflation could come back. And so if we think about the most bullish scenario for markets, it was that we could get good growth, inflation would moderate, and the Fed would be incrementally easier. If you take that last part out, it just means that valuations can't be the sole upside driver of this market, and we need earnings to really be the thing that kicks in to drive markets higher.
I mean, it's interesting. It seems as though
100%. That's a great point. And if you really want to know what stocks are going to perform the best into, let's just call it over the next 6 months or so, okay? The stocks that are going to perform the best over the next 6 months will be the stocks that come in with the best numbers when they report in October, November, and then report again in February. And those stocks will move up quite substantially if they report great numbers. And the ones that won't move up, okay? We're going to be in a very, I wouldn't expect just huge upside in the indexes at all over this next 6 months. Yeah, if it comes, it comes, but I just would not expect that. It's going to be the ones that perform, really come in with the numbers, are going to do phenomenal, and the ones that won't. And they'll just continue to kind of be on the side of the road versus what the NASDAQ was for the first 6 months of the year, where it just kind of pushed up all NASDAQ stocks, regardless of your earnings, regardless of what was going on there.
The biggest problem you could argue for.
Perfect example is Apple. Look at Apple's move up this year. Is that based upon fundamentals? Is that based upon earnings? Absolutely not. That's simply just based upon the fact that the whole NASDAQ was going up and just people are piling back into tech stocks. Like Apple's numbers are horrible this year. It's like the worst year for Apple in quite some time. Those numbers aren't good. They're shrinking revenues. They're shrinking profitability. But the stocks moved up substantially, obviously, this year because just all NASDAQ kind of pushed up.
Fed at this very moment is not necessarily the level of inflation. It's the level of economic growth.
Yeah.
Much stronger than they had even expected it would be.
Very much so, because if we go back to the Jackson Hole meeting in 2022, Powell said that a period of below trend growth would be necessary in order to get inflation back to their 2% target. That's what they forecasted in their S&P in their SEP all this year, and that simply hasn't materialized. So it's not just about what the inflation reading is today, it's what the inflation reading is in the next 6 months or 12 months. So they are concerned that if growth is above trend, that would cause a reacceleration in inflation, which is why they don't want to talk dovish, because the risk would be then that inflation would reaccelerate, and then they'd have to do a lot more.
But do you think a risk of recession is a higher probability at this moment because of that more hawkish tilt?
I'm not sure if it's necessarily a higher probability, just because what's 25 basis points of an incremental difference? We think that there is still risk of recession in 2024, but the timing still remains highly uncertain. There was so much expectation for it in 23, but we're just now starting to see the bite of higher interest rates. So look at some of the housing data starting to roll over again. It will be really interesting if we start to see things like new home sales roll over, given where interest rates on the mortgage rate is going. So I think overall, we still don't think that we are ready for an imminent recession. We think it's still more of a 2024 question. And eventually these higher interest rates will bite, but we simply haven't seen the evidence of it yet.
So the question
100%,
is...
and when she says interest rates bite, that's basically goes back to what I've been talking about with the Fed lags catching up with us, and that they're going to catch up either in 2024 or 2025. It's just a question of what year are they going to catch up. I think the higher probability is they catch up to us at some point in 2024.
To do now if you're an investor after the Fed decision. I want you to listen to what Jeffrey Gundlach of Double Line Cameron told me yesterday about what the ideal portfolio might look like right now.
Let's hear it. Oh my gosh. And then they just showed it off there. I mean, they choose to like cut these clips at the most random times, I swear. Oh gosh. Appreciate everybody joining me as always. Love to hear your guys' opinions and perspectives in that comment section as always. Thank you for being subscribed, new all-time high subscribers. If you enjoy the channel and you want to support me on Patreon. That is pinned comment down there. And you get to see the 4 stocks I bought here today, plus the moves I make in the future. Much love and have a great day.